In today's video, we're taking a close look at a particularly interesting stock. I'll guide you through an in-depth analysis examining its financial health, industry position, and potential risks and rewards. This detailed approach is aimed at providing you with the essential information you need for your investment decisions. Join me as we explore the complexities and opportunities this stock presents. Hey friends, welcome back to the channel. If you are new here, I'm Cody Koch, a 25-year veteran investor, former hedge fund trader, and business owner, and on my channel, I try to make my viewers money by bringing them investment ideas like this one. So today I'm going to discuss Academy Sports and Outdoors, ticker symbol ASO. Now this company was originally founded in 1938 in San Antonio, Texas, known as the Academy Tire Shop. A few years later they changed it into a military surplus store, and then over time it began to evolve into what it is today. Academy was purchased by KKR back in 2005, and as part of a turnaround plan they hired Ken Hicks to become CEO of Academy. Ken is known for successfully turning around Foot Locker, and so they brought him on as CEO of Academy in order to do the turnaround. His plan originally was to grow revenues from $4.8 billion per year to $6.5 billion, to achieve and sustain a net profit margin of 5%, gain a 10% EBITDA margin, achieve a 17% return on invested capital, have at least a 3 times inventory turn, and get sales to about $325 per square foot. All of these metrics were hit or exceeded by 2023. KKR started unloading their position back in 2020 and 2021, and today the company has about 277 locations throughout the United States. Now real quick, the way I found this stock is I ranked all stocks by earnings yield. Stocks with the highest earnings yield got the highest rankings. Then I ranked all stocks by return on invested capital. Stocks with the highest return on invested capital had the highest rankings. I combined these two rankings, and from this list of very high ranking companies, I chose a handful of stocks that I really liked and I thought they had great potential in the future. Stocks that match this criteria on average have produced 15 to 20% per year going back to the 1970s. Let's get into the financials. Now you can see here the revenue chart showing a steady growth over the last number of years to go flat for the next few years, which doesn't bother me at all. Earnings per share expected to remain steady or slightly increase over the next few years. The company's total return on capital is actually very nice relative to both its sector and its industry, and relative to itself over the average of the last 5 years. The company's quite profitable. It's got some nice profit margins, return on equity, other factors as well. Profitability relative to its peers is very good. All right, next let's check the income statement. You can see here is February 2018. Company went public again in 2020, so these are a few years prior to when the company was public under KKR's ownership. You can see its overall revenues have significantly grown over the years, a nice steady increase. In fact, gross profits have gone along with it, which is very good, and net income has followed relatively suit and doing pretty well overall. Balance sheet in the company looks pretty good. It's got $311 million in cash. Total assets are about $4.7 billion. Total liabilities are about $2.9 billion. Most of that is in long-term capital leases. This is leases related to the real estate of their stores. Common equity is about $1.7 billion. Now let's get into the valuation. The PE ratio of Academy is around 7 times earnings. This is about half the PE ratio of its sector, although it is approximately the same PE ratio that Academy has had over the last 5 years on average. Its acquirer's multiple, or enterprise value versus earnings before interest and taxes, is around 7 times earnings, as you can see here, which is about an average it's had for the last 5 years. To put it in perspective, companies in its own industry, its valuation of around 7 times earnings. With that valuation, Academy is one of the cheapest companies in its industry. Now real quick, I'd like to discuss the Net Promoter Score of Academy. The Net Promoter Score is a measure of customer loyalty, and it measures between a negative 100 up to a maximum of a positive 100. Academy consistently scores around a 43 on this measure. To put it in perspective, this compares to Dick's Sporting Goods, measures around a 26, Bass Pro Shops around a 33, Amazon is around a 37, Walmart is about a 21 on this score, and Target is a 15. Academy has consistently scored 10 to 15 points higher than the retail market's average Net Promoter Score. So Academy went public back in 2020 when KKR had decided they wanted to unravel their position. Since then, the stock has risen quite dramatically, but I still think it has quite a ways to go. At one point, the stock got around $68 per share. More recently, it's dipped down for a variety of reasons we will talk about. So the major risks to Academy are the overall economy. In fact, that's pretty much the only risk to Academy stock I've been able to find at all. The company, for the most part, has run very well. They've been able to get a lot of things to go in their favor quite a bit. They're doing very well compared to a lot of their competitors. The only thing they're really running into is the slowdown in in the overall economy. Naturally, sports and outdoors products are somewhat of a luxury. When money starts to get a little bit tight, people stop spending money on those kind of luxuries, especially when they need to buy things like food. Now, how they're planning on getting out of this is very interesting to me. They have a 4-step plan that Academy is focusing on, and they are very much focused on growth going forward in the next few years. So the first part of their plan is to expand the number of stores. They've been working towards this expansion for some time. They have built 3 large distribution centers, and within a certain distance of these distribution centers, they are going to be adding approximately another 100 to 135 stores in the next 5 years. The reason they're trying to do this is it significantly improves efficiencies being within a certain distance of these distribution centers. This is expected to notably increase profit margins due to the efficiencies they're going to gain from this. The second part of their plan is they're expecting their same store sales to increase. Academy's been doing a lot of things to appeal to a lot of clients. For example, the Net Promoter Score shows that they have a large amount of very loyal customers, at least compared to other retailers in the industry, and for that reason, they're expecting that they will have increased same-store sales. Third is due to their distribution system they put in place, they're expecting their inventory turns to go from 3 to 3.5 times, which should not only increase efficiencies, increase profits, and also lower the amount of capital needed in the business to keep up the amount of inventory. Fourth, they plan on distributing excess cash in the form of either dividends or buybacks of the stock to shareholders. Next, let's do a scenario analysis of what's possible and where this stock could possibly go. Now, one thing I like about Academy is that its profits are growing nicely, and even if profits stay very flat from where they are right now, at a 7 times earnings, you should be able to produce a pretty nice return on your money every year going forward. So first off, let's start with the worst case scenario. Let's imagine there's a 5% chance the stock could go to 0. Now, I don't expect it to be anywhere near that high of a chance of this occurring, but let's just say it is. This is a way to protect us and keep us disciplined in our analysis. Next, I estimate there's about a 15% chance the stock could fall by 50%. That's fair. Anything can happen that can occur. It could even be a stock market crash that could easily occur to cause this. Has nothing to do with the underlying fundamentals of the company. Next, I estimate there's a 30% chance of the stock declining around 20%. This is just a nice, safe, rough estimate. Stocks can easily bounce around like that and have a 20% loss. Maybe the business slows down a bit, economy slows down, something like that could easily occur. Next, I estimate on a positive note, there's a 30% chance the stock could go up by about 50%. Given that I think it's undervalued and that the growth is coming on board, I think there's a comfortable chance the stock will go up by 50% in the coming year or two, so I estimate that. Next, I estimate there's about a 15% chance that the stock could go up by 100% from where it is today. That would basically be a double, would mean it would knock it to about $98 per share. The reason I estimate this is possible is due to the large amount of very profitable growth Academy is set up and geared for, so I think this is a great possibility. Lastly, I'm going to assume there's about a 5% chance something really great can happen, and the stock may go up by 200%, which would put it at around $147 per share. Now, I'm not expecting a very likely chance of this occurring, but I do like to have it in the data a little bit just in case this extreme possibility does happen, because there's always a chance something like this can occur, and it allows me to understand the investment potential of a stock like this. So you throw all these statistics into some algebra. On average, the returns are expected to be around 21.5% for the stock over the next year or two, which I think is pretty compelling. Next, let's talk about risk management. Now, the best way to manage your risk in a stock like this is to use proper position sizing. I would recommend purchasing no more than 5 to 10% of your total portfolio into this stock. Anything over 10% is simply too much risk. Exit strategy. Now, I would recommend when you buy the stock, wait a little bit past 1 full year before you consider selling it. At that point, go ahead and reevaluate the stock. If it still looks like a good opportunity, go ahead and hang on to it going into the future. The longer you hold this stock, typically the more profitable you will be. An added bonus of waiting for past 1 year, you will get capital gains taxes, which should lower your tax bite a bit. Trade execution. To save money on the bid-ask spread, I would recommend do a limit to buy on close order or a buy on close order. Alternatively, you could do a limit to buy in the market below the prevailing bid at the time you do the purchase and simply wait, give it a couple of days or a week or so, and there's a 90+% chance it'll get filled. If not, go ahead and change your bid at some point in the future. That will help you save the bid-ask spread, which can actually add up and be quite a bit of money in the long run. Now, related to trade execution, how and when to buy your stocks, I wanted to show you this. Now, a lot of people are unaware of this, but here's data based upon what stock market returns you would get based upon what time of day you buy and sell your shares. So, for example, if you had bought on the close of each day and sold the following open of the market, your returns in the S&P 500 would have followed this blue line going back many years. However, if you had bought on the open and sold on the close of each day, in other words, you only owned it during the intraday trading and never owned it overnight, you would actually have returns that match this, okay? So what does this tell us? And this, by the way, matches pretty much across almost all stock exchanges all over the world. Now, it's not well known or understood why exactly this is. You'd have lost 100% of your portfolio and never owning anything overnight. Whereas if you'd owned it overnight, you would have made a dramatically higher return on your your money in India. This is pretty much the case in all markets. As for China, China may be a little bit different, or it could be erroneous data. I'm not really sure. But in any case, there's something very unique going on here. The reason this is so important is if you plan on owning a stock in the long run, you were better off buying it on the close, because throughout that intraday, it's more likely to have gone down all day, and you would get just a little bit of a better deal if you would have bought it on the close. And when you go to sell it, you're better off selling it on the open of that day you plan on selling it. Why? Because again, intraday, the stock on average goes down. You'll get a little bit of a better fill and a little bit of better price. On the reverse side of this, if you ever choose to short sell a stock, the best time to short sell it is on the open. Best time to buy it back or cover your short is on the close of the day. This does add up a little bit over time, although very small amount. It does matter, and it will help you compensate for your transaction costs. As for your psychology, as always, I would recommend use a calendar alert on your phone or your computer. In the meantime, do not even look at the stock. Once you get that calendar alert, then you go ahead and reevaluate the stock and decide what you'll do at that point. Just don't pay attention to it in the meantime, because it'll just stress you out. Even if it's highly profitable or unprofitable, it will make you very uncomfortable. So there's no reason to add all that stress to your life. So in this video, I did a deep dive into Academy Sports and Outdoors. But in a previous video, I did a deep analysis of a very undervalued marine transport company called Euroseas. You can watch that video here. And if you would like to see more videos like this, please hit that like and subscribe button, and I will see you in the next video.